Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global market update right here from the central London studios of Core TV in the heart of the financial district. I am Martin Baccardax, the London bureau chief here at TheStreet.com, and I'm going to take you through those 5 things you need to know before the bell. Fascinating day in global markets and indeed here in Europe as well, and it's going to be interesting on Wall Street too. Let's take a look at what we're looking at right now across the European space, because in point of fact, the broadest measure of European shares hit a 5-month low earlier in the session. We've been tumbling for most of the week. This is the 3rd consecutive session of steep declines. And while we have stabilized a little bit, as I say, we have hit that 5-month trough. It's an interesting dynamic indeed. Of course, the tensions in and around the Asia region with respect to North Korea, but also with respect to the fact that China doesn't seem to be on board with the new bellicose nature of U.S. Diplomatic relations in North Korea is also part of the reason. And we are seeing a pullback across the board. Japan was closed today for a national holiday, so actually Asia shares took the brunt of the investor bearishness and actually traded at a 2-month low across the board. We actually saw the yen, despite the fact that Japan was closed, rise to an 8-week high against the US dollar. That seemed to be part of the safe haven trade. Gold didn't budge as much as I had first anticipated, but got up to about the 1286 level. But nonetheless, the fact that investors were ready to take risk off the board is a big reason that we're down here in Europe today. There's also some specific news inside the metals and minings industry with respect to the potential for demand for higher collateral for some of the leveraged traders in Asia, and that put pressure on miners. Oil prices also drifted a little bit lower after the IEA basically knocked the attempt of OPEC to stay together on production cuts compliance, and as a result we saw WTI crude prices drift, and that was a drag on the FTSE 100. But specifics aside, it's definitely one of risk off today, and that is being played out in Wall Street futures. Now, we talk about risk, we have to talk about the fear gauge. The VIX, the CBOE index of volatility, hit a November high last night and extended that into the Asia trading session. And I would imagine it's going to increase again today. Effectively, what this does, for those of you who are not familiar, it uses very complicated calculations of options and the volatility implied within their price to give you a gauge of where investors expect volatility in the broader market to be over the next 30 days. It's linked to the S&P 500, and as a result, we saw the spike yesterday of about 44% in the VIX level, and that led to the biggest tumble for the S&P 500 since May 17th. So the connectivity from a programmatic point of view is clear, and as a result, this is something that if you are a passive or an active investor, you need to pay specific attention to. Now, we have spiked to levels that we are seeing at the moment, or close to them, a couple of times over the past year. Certainly at the back at the time when we were looking at the James Comey memo and the controversy surrounding the ongoing investigations into Russia meddling into the election, the VIX spiked. We also saw a spike, of course, around the election time, and indeed last year right around the Brexit vote. So these are not unprecedented levels by any measure, but the fact that we are rising now is interesting because, of course, we have the precursor of the tensions in North Korea. But it also has to be remembered, we've had a relentless bull market since November. This year to date, we've had 35 record highs for the Dow Jones Industrial Average. For the NASDAQ, we've had 44 all-time highs for the tech-heavy benchmark. So the fact that we have had these relentless rises whilst equity volatility was at or near historic lows was really troubling to a lot of people, because the assumption was that when they wake up from the slumber, markets are going to pull back very, very quickly. What I think we can take pride in, or at least a little bit of solace in, is the fact that we did get that big spike in the VIX, and though we did see a specific and notable fall in the S&P 500, and indeed about 200 points off the Dow yesterday, we aren't seeing a calamitous decline. The markets do seem to be taking it in their stride, and the efficiency that's built in, maybe some of the lessons as a result of the financial crisis in 2008, and dare I say it, some of the protective legislation that was put in place by lawmakers, which was beaten back by bank and industry lobbies for many, many years, is also part of the reason why that we seem to be going in an orderly fashion at the moment. A correction at this point, I don't want to use that term and I apologize for it, a pullback at this point is probably warranted given the fact that we are seeing slower economic data, there are these rising geopolitical tensions, and we have hit these multi rise. So it's not a bad thing to reprice, recalibrate, and take a breath as we head into the lull of August. But nonetheless, the fact that these volatility figures are starting to move to the upside does give us reason to be cautious. And as I say, whether you're active and passive in terms of your investment strategy, do pay attention to what the VIX is doing, because it offers an excellent signal as to where we are likely to be in 30 days' time. Okay, we have to look at some specific stocks today. Nvidia is one of them that has been a big mover last night and again today. We're looking at an 8% decline in pre-market trading. The chipmaker giving us some quarterly earnings last night, which were actually pretty good. The beat on the top and bottom line, revenue grew by about 56% to 2.23 billion, and actually the earnings per share came in at 92 cents. This has been a stellar performer over the last 52 weeks. It's gone up 181%. It's up 54% year to date. So why the significant pullback? I think people were drilling down into some of the individual division numbers, and they weren't exactly pleased with what they saw from a revenue point of view. In the data division, revenue came in twice as high as it did last year at 416 million, but it still missed analyst estimates. Auto revenues came in 20% higher than the same period last year to 142 million, but again, missed estimates. So I do think you are looking at just a little bit of specificity inside this stock from the analyst point of view, given the fact that it's had such a tremendous year-to-date and 52-week gain. Our Jim Cramer, the founder of TheStreet, who runs the Action Alerts portfolio and contributes to Real Money and, of course, all across the platform, has liked this stock for a very long time. He said it's been perfect for a long time, and last night's numbers were a case of it being imperfect against a track record of perfection. He sees it as a product transition story at this point, and he's not exactly terribly troubled by the numbers that we're seeing. And when you consider the fact that this is a stock that is going to be leveraged against the growth that we are anticipating in driverless cars, in artificial intelligence, and elsewhere, it does have a value perspective that is worth looking deeper into, despite the fact that we have this little bit of a quarterly bump. It's one of those future stocks, I think, that is very difficult to ignore even when you get this kind of bumpy ride. The analogy that everybody draws, and I really do think it's a good one, is if you go back to the gold rush, you will discover that many of the people who actually made the millions were those that sell the pickaxes and the pans and the kit for people to go out and mine in the gold. And of course, the analogy is perfect for Nvidia and others, because many of their graphics designs are used in the software that data miners use to go and track Bitcoin currency transactions and the blockchain technology. And of course, that isn't going anywhere. In fact, I looked at Bitcoin earlier this morning and it was trading at $3,500 US a piece. That's going to be with us for a long time. The artificial intelligence and the move into self-driving cars and other autonomous products isn't going to go away either. Nvidia is nicely placed, and despite the bump, this is a stock that can't be ignored, and actually it might be a time to get back in, given the fact that it's much cheaper now than it even was 2 days ago. Snapchat is another one that might be a stock of the future. It is certainly not a stock of the present. It's down 13% in pre-market trading, and we're going to go well past record lows at the start of the session. That is probably going to mean that we're down around 60% from the all-time high hit just after its much hyped IPO. Missed on the top line in Q2 earnings last night, missed on the bottom line in Q2 earnings last night. Both of the numbers were falling short of analyst estimates and really raised troubling questions about the company's ability to monetize. Now, the founders, Evan Spiegel and Bobby Murphy, have both come out and said, listen, we're not selling our shares in this group. We are committed to its future, and we're staying in. We have talked a lot about the lockup period in and around Snap shares creating volatility, and a lot of people are going to be minded to get out as a result of that. Not Mr. Spiegel and not Mr. Murphy. And I do believe, however cynical you might be, that speaks volumes to their commitment to the company. They may not have any choice, but that doesn't really matter. Sometimes your best work is done when you don't have any choice. What I am troubled by, however, is the fact that they do appear to be pushing their strategy again to the graphics side as opposed to the monetization side. They actually, Mr. Spiegel raised the example of the dancing hot dog. You may not be familiar with it. If you have a teenage daughter, you probably are. It's been viewed by 1.5 billion people around the world, and it really is a bit of a phenomena and sort of articulates the strength of the Snapchat platform in and around the milieu of social media. But if you can't make any money from it, it's difficult to see why intensifying the ability to create WYSI graphics is going to be the answer to your problems. Now, daily active users, actually those numbers weren't too bad, and what you were seeing, they missed estimates, but you're still looking at 173 million daily active users, and you're getting about $1.05 from each of them. Both of those narrowly missed the street estimates, but I do believe that Snap needs to come up with a way in which it can monetize or more neatly insert advertising principles and potentials inside the messaging in order to steady the ship. But they haven't done that yet, and who knows, they could be right. They certainly understand their business better than I do, but I do believe that the overfocus on graphics at this point might not give investors the solace they need, and they still may need to wait a little while longer to come back into a stock that I still believe has potential, but at the moment certainly needs to express it in a much more clear fashion. Okay, let's take a look at Wall Street. The futures are moving in and around and all around, but they're not doing too bad. The Dow is called 20 points to the downside. The S&P 500 about 5 points. That equates to about 0.2%. And we're looking at a little bit of a steeper decline for the NASDAQ of about 19.5 points. That's about 0.3%. We are going to get some inflation data for the month of July, of course, and that will be a very important figure, not only for equities, but also for bond traders, as all of us really try to understand exactly where the Fed is going to head into the second half of the year. Analysts are looking for a year-on-year increase of about 1.8% in U.S. consumer prices. If we do fall short of that, if inflation is shown to be not accelerating to the pace that investors are anticipating, then you may be able to coagulate all of the political tensions you're seeing right now, some of the concern you're seeing about European growth and indeed about global growth, into the bond market, which of course is being bid up significantly as a result of the risk-off tenor in global markets. And if that is the case, and we do see interest rates in the market continue to fall, then that certainly will change the Fed's perspective as to how fast they need to go in order to raise base rates. So this inflation figure now, and of course employment and wage figures in the coming months, are going to be incredibly important, and there will be a great deal of market volatility in and around them as a result. So we will pay attention and come back to TheStreet.com at 8:30, and you'll see exactly how the market reacts.